Okay, folks, good morning and welcome to Market Wrap for Monday, but I'm doing this on Tuesday morning. Why? A couple of reasons. One, I wanted to see how the yield curve would close out the month, but that didn't update until very late last night. I was too tired to do this. And two, I was looking at the futures late last night. I was watching Nat Gas, of which we got long of yesterday. And it was very strong price action, but I was also looking at the NASDAQ. Let's go to the big screen here. And this is the NASDAQ 100 futures. And they did the same type of price action the night before, where very dramatic rallies and then very dramatic pullbacks. And you just see it over and over again, very two-sided. And that's not something we've seen at all of late. So really just something to keep an eye on moving forward. Because remember on Sunday Night Futures Live, when we went live and the futures opened up slightly, pretty much flat, biased to the upside. Then they took off after the show ended, and they were up, I don't know, about between 1/3 and 0.5%. Don't quote me on that, in that range. And by the end of the evening, they were not negative, but flat yet again. And by morning, they were flat. Here we are yet again. They tried to push the futures up higher last night, and they retreated some. By the time I went to bed, flattish, and now we are down this morning by spot 4%, spot 3.9 if you want to be specific. So, a strange price action. This is the first day of the year. I do think that you had end-of-month window dressing yesterday, meaning they really spiked the market up higher in the final 15 minutes of trade. That way they can catch that extra couple of basis points on their statements when they send out their end-of-month results to their clients. When I say they, I'm talking about hedge funds, etc. So just a quick observation of the morning's price action. That current is 5:52 a.m. Eastern Standard Time. All right, let's go to the closing price action of yesterday's charts. Actually, before we do that, let's talk about expectations of a Fed rate hike in September. You would think that the markets would be rallying. Of course, they did in the final minutes of trade yesterday, but they were negative 15 minutes earlier. You would think that equities would be rallying up higher when you have in front of you a Fed pause for the month of September. And last night, this went up to 80% since it's dropped back down. That's why I check it so frequently, because it changes so often. So with the Fed pause in rate hikes, why aren't equities rallying? Well, I think it all goes back to the yield curve. Let's check it out. The yield curve on the last month closed up. Now, for those not familiar or new and don't understand what the yield curve is, it's predicted every recession since 1955. Don't worry all that much about when it's inverting. Worry about when it steepens. That's when the crashes happen. So you can see it closed up. Now, as a technician, I'm going to be looking for a gap up into this wick, because in technical analysis, more often than not, and it's not 100%, nothing's ever 100%, more often than not, you get a gap up into a prior period's wick, in this case a monthly period. That's bullish. If you get a gap down into the prior period's wick, like back here, that is bearish, but that didn't happen. So we'll be watching this with bated breath. Let's move on to the closing price action. Yields continue to consolidate. They pulled back a little bit yesterday, but 3.95 is a strong read, close enough to 4% to make people worried. And where are we this morning? We're up a little bit here, 3.599 on the 10-year. Actually, we're flat. I want to rephrase that. We're flat relative to yesterday's close. This is not a real-time chart. TLT, 20-year bond ETF, up on the day yesterday. Again, we have a wick on this candlestick. Do we gap up into it, or do we gap down into the body? If you gap down into the body, not necessarily bearish, but it's not bullish. Volume, pretty good volume. Treasury inflation protected securities, they're thinking pause. they're moving up higher. Let's see if they could break out above 107.83. That would be a higher high after putting in a lower low. That would give this instrument teeth to the upside. The dollar, here's the problem. Dollar looks like it wants to go higher. And I was listening to, I have to get his name. He's a statistician. And he's of the mind that the reason why the dollar would not become the world's reserve currency because of a crash up, because so much debt is denominated in U.S. dollars. So a crash up in the dollar would be very, very bearish. I need to think about that a lot more because he's a lot smarter guy than I am. But interesting, because it would certainly hit the emerging markets really, really hard. The VIX closed up yesterday, but faded off the highs of the day. I don't love the price action. Let's see how we closed out the session. This is the VIX index, not the front month contract on the futures. They do look different at times. We are putting in higher lows, but it is bullish for the VIX, I guess, the fact that we closed up on equities, down and up on VIX as well. So something to think about. We've been seeing the inverse of late many times. The Dow Transports finally took a pause. They are still in fuego, and there's more room to the downside. I don't know how sustainable this is to the upside, to be honest with you. You can see the RSI is rolling over. Down volume, though, is very light. And we are very, very extended here on stochastics. I mean, this is a lot of periods of being above 80. And I always say that, you know what, if you're going to short a stock based upon a stock or an index going above 80, you're going to get your face ripped off. In this case here, we are very, very long in the tooth. I still wouldn't necessarily short it because we haven't broken support levels and down volume is not high, but something to think about that we are very extended here and we may get a correction in the Dow Transports pretty soon. The Dow Jones Industrial Average. Now, this flies in the face of what I just said about the Dow Jones. If you're a Dow theorist, meaning the Dow theory is that the Dow Transports and Dow Jones Industrial Average should validate each other. And they recently have been. For a while, they were not. With the Dow Jones Industrials outperforming, now you have the Dow Jones as recently as yesterday breaking out yet again, hardly putting in the performance of the Dow Transports year to date. But they're breaking out of a sound base, laddering up higher, stair-stepping up higher. So pretty bullish price action here on the Dow Jones. The question is, how is volume? And volume is pretty good. It was about average yesterday. The S&P 500, very long in the tooth. So remember, VIX is supposed to trade inversely of the S&P 500. Yesterday, they were both up. Interpretation. My interpretation of that is that while they were willing to bid the S&P 500, they're looking to put on some VIX insurance. They're buying some volatility because it's so cheap. Do we short it here? No. The path of least resistance is to the upside on the S&P 500. Why fight the market? Now, the Qs to me, they're a somewhat different story. Yesterday, we need to go to a weekly chart because not to do so would be not wise. Because on a weekly time frame, we broke out yesterday, if you can believe it, on a weekly time frame. Now, I think this is what you call a breakout in time, meaning it wasn't so much the price action that drove us up high. It was simply the fact that we were so tight within a wedge formation that simply the fact that we opened up a new candlestick, it took us outside the bar. Is that sufficient enough to call it a quality breakout? I don't think so. I never have been of that opinion. That doesn't mean that it's not going to follow through. I will point out, and this goes back to the weekend. This is not a new week thing where it's going to change anytime soon. This is in the books. We have a double top on ADX green, and momentum on a weekly histogram is very, very negative. Now, I've seen this happen many times where this goes in a negative direction. All of a sudden, it reaccelerates to the upside. Because so many people use MACD, it's just the market's squeezing them because they're setting up short positions. So, yes, we are long in the tooth here on the MACD. I would not be surprised to see us go negative at some point in time in the near future, but I would not go heavily shorting the Qs right now because, in fact, they are broken out, not just on a weekly time frame, but on a daily time frame as well. With volume to the upside very, very light yesterday, which again puts into question the quality of any breakout here. And the fact that on an intraday basis, you had names like Tesla and, I'm just going to type it in here to make it quick. Let's go to a 15-minute view. And I'll show you the quality of the price action yesterday. So here is the Qs in general. They were taking it lower, and then they got a reversal bar, salvaging the rest of the market. So you take a look at Tesla, lower highs on stochastics. It was higher, then faded, then the final 15 minutes of trade, the algorithms came in and bid it up, and they did it on okay volume. Meta, of which we have a short position. We'll talk about the closing price action later. This closed very weak. It was initially higher, and then it went negative. That's a bearish reversal bar on the session. Look at the volume into the close. That's, again, the algorithms coming in to salvage it. But look at the quality of the close. It was almost a doji star formation, a sign of indecision. It was flat, that final 15 minutes of trade. A lot of volatility on volume. That tells me that there's a tug of war between bulls and bears on Meta. We'll stay short. MSFT. We'll go over the daily charts in a minute. MSFT daily chart. Look at this price action. It was weak most of the day. They bid it up into the close. I think this is end of month window dressing. The question is, what do they do today? Do they distribute shares or do they accumulate shares for the new month? Now, while the Qs, for the most part, even though we broke out on a weekly and daily time frame, were strong. I mean, they weren't impressive at all. The IWM was really impressive. I mean, look at this breakout here on the small caps. Remember, it was only 3 days ago we put this is last Thursday, we put in this outside reversal bar. And I spoke about this a few times. When the markets do something you don't expect them to, meaning after this outside reversal bar, we should have continued lower, and we do not. We bid up, and then we moved out higher. When the markets don't do what you expect them to do, that is an underlying bid in equities. Stochastics really, really strong here. RSI strong. Volume is light though. You would want to see much stronger volume than this on this type of a breakout. The banks consolidating nicely. They are rolling over on Stokes, but they're consolidating. Up volume was light. I was watching this bearish divergence on Ultimate Oscillator. We have, in fact, broken down below the lower band of support. That is not bullish. Technology. Consolidating nicely here. I mean, this looks like it wants to go higher. These are highly correlated to the triple Qs. So, again, we have a short position on to act as a hedge against our long positions and our options trading positions, which are, in essence, neutral. So the short position protects our put side. So we're not net short the market. We have a short position to protect our other positions. And this looks like it wants to break out higher. Staples took it on the chin yesterday. Down nearly half percentage point. Light volume. Not much to talk about there. Discretionaries consolidating. Bidding up higher. This is a weekly chart. And I want to go to a daily chart. I'm not really concerned about a weekly chart. Daily chart. Good day yesterday. Closed at the highs of the session on declining up volume. Not great. DBA food prices. We spoke about this on Sunday Night Futures Live, where agriculture was looking pretty weak. We did get a pullback on the DBA, which is an agriculture ETF. The caveat there, we rallied off the lows of the session. Do we break out? Do we consolidate and put it in the double top? We don't know yet, but if we break out, that is inflationary. Energy, very strong price action. And in fact, what we did here is that we broke out above this prior high back here in April of 2023. So, folks, energy is moving up higher. Unless, of course, the rest of the market corrects, this is going up higher. Oil, it is also moving up higher. Also inflationary. Now, gold, it broke out yesterday above 2,000. Now, in looking at the price action last night, this may have changed by now. Yeah, it's down 14.60 the ounce. If you're a gold bull, you don't want to see gold close back down below 2,000 the ounce, because that's a breakout point failure. It's not bullish whatsoever. So let's keep an eye on this today. Now, as for the gold mining stocks, they caught a bid yesterday, but remember, the dollar was up as well. Equities are expensive. And I keep warning about this. The charts are extended, yet still bullish. The markets can continue up higher longer than you can remain solvent if you want to short it. That being said, if we do sell off, remember the yield curve. If it steepens, we're in trouble. What did the yield curve do last month? It closed up. Now, if equities do roll over, everything goes down, including gold. Why? Because people don't want to sell what they want. They sell what they can. And also, if we're rolling over, it's because of this. Believe it or not, this is going to come back to haunt the markets. If we are in a bull market and the stocks are relatively inexpensive, and the Federal Reserve is in rate cut mode, then equities can move up higher. But we have an economy where we saw GDP grow at 2.4%, but guess why? It was because of government spending, not private sector spending. All they want you to do is to look at the headline number and see that GDP grew at 2.4%. They don't want you to know the why. The why was government spending. So if the Federal Reserve goes into a rate cut mode with equities this expensive, the markets are going to say, why? What's wrong? And in times past when we've seen this, the yield curve steepens and we get deflation because equities are in free fall and an expensive equity market is inflationary. Have no doubt about it. Asset prices are inflationary. If you're new to the workforce and you have to pay up for a stock at a multiple that's well above the historic norms, well, that's inflation. Same thing holds true for real estate. So if the stock market begins to sell off, you get the reverse wealth effect. People cut spending, therefore creating deflation. What does not do well in a deflationary environment? You guessed it, gold mining, silver stocks. And yesterday, I did see this chart midday. It was an impressive rally. The NUGT is fighting to avoid a negative crossover of the 50-day down below the 200-day moving average. In fact, on Friday, it had a positive event, meaning that the 20-period moving average crossed above the 200-period moving average. This is exactly what you want to see. Now, we own some of this. Would I go buying more? Probably not. Probably not right now. Why? Because the dollar is strong. NUGT, the gold mining stocks, and generally gold trade inversely of the U.S. dollar. I didn't make it up. It was like that when I got here. So NUGT right now at a crossroads. Do the 50-day death cross occur? Or do these moving averages begin to move up in tandem, which would be extremely bullish? Let's check out the quality of the close here. 15-minute chart. And here's what I was worried about. They faded it into the close. GDXJ. Now, the GDXJ, same deal here, or similar deal here. You have the 20-period moving average in green cross above the 200 and the 50-day moving average. Very bullish price action. It was up yesterday. Volume is really good here. But you had the same type of price action in that relative to the NUGT that we were strong on the day until the late hours of the day, and then we faded off the highs. Now, again, if they gap us up into this wick, that's something to talk about. If they gap us down into the body, or God forbid, down below the lows of yesterday, this morning, that's going to be a major problem for the mining stocks. Silver, strong day yesterday. In fact, a little bit of a topping tail, but not much in terms of negative close yesterday. Volume was light, though. Stokes are going in the wrong direction, meaning that momentum is not what you expect it to be. And when you see Stokes like this declining, it just means that rallies have a higher probability of failure. Generally, you want to see those lines moving up higher. Silver miners, they were up yesterday, and we have a position here, strong price action, and improving with the moving averages. But again, you worry about the overall market, not necessarily the individual names here, with a dollar that's strong and a market that's very, very expensive and extended. These two shall go down if this market goes down as a whole. Now, LEBU, we added more to our position yesterday. Why? Let's talk about it. On a monthly chart, we held the lower band of support, which is bullish. We've been in this trading range for several months now. We bottomed out back here in May of 22. So well over a year, we've been in this consolidation range. And as I always like to say, the longer the consolidation, the greater the validation of a move, in this case, where you're oversold and move higher. Stochastic, which is your momentum indicator, they're beginning to lift off now with higher highs and higher lows. Last month's volume was positive and it was high. So a lot to like here on LABU. Now, to the daily chart yesterday, we broke out. All right, so this is the reason why. Those are the two reasons. End of month closing price action. I profess that all the time. If you're hedging your thesis on a monthly chart, try to wait until the end of the month to put that trade on, to ensure that if you're watching the stock, it looks bullish early on in the month, well, especially if it's in a trading range, well, let's make sure that it closes at or better where you're looking at that point in time, because it only strengthens your hand. You may pay up a little bit, but the probabilities of success increase. Now, yesterday we broke out of a descending wedge formation, and we closed above the 20-period moving average, back above 6. Our basis cost on that buy yesterday was $6.01. Stokes hooking up now. Volume could have been better. Emerging markets. Okay, we have a position here. I haven't been willing to add to this position because the dollar has been strong, and emerging markets trade inversely of the dollar. They've been shrugging off that traditional inverted relationship, but I don't expect it to last long if the dollar moves up higher. So I'm going to stand pat. We're going to hold our position, not going to sell it, but let's avoid putting our head in the noose here. Netflix, of which we have a strangle on. That's an option strategy, selling a deep out of the money put, a deep out of the money call. Basically, we're just generating cash flow. Strong move up higher yesterday and closed at the highs of the session, up 3%, a very respectable move. Volume was below average, so our strike is up at around 375 on Netflix, with historical resistance at 485. The multiple, nearly 47, so not cheap. BHP Billiton, we opened a position here. This was one of our favorite stocks, best stock charts, about 2 weeks ago, and we opened a position on this breakout. Ever since then, we haven't added more due to the fact that it did not hold that breakout. So we sit with a very small position, but you can see that BHP is attempting to break out yet again. Now, we will wait for that breakout to occur, and then we adopt what you call the 3-day rule, because it failed to hold the breakout the last time. Now you're a little bit suspect. So the 3-day rule is that we close above resistance. We want to see a retest 1, retest 2, or retest 1, and then follow through to the upside. Then we'll look to open up more of a position here. Till then, it's a show-me stock. It's going to show us that it's worthy of our investment dollar. Actually, no, we bought it back here. We didn't buy it on the breakout. We bought it back here. So we're actually up on the trade. Meta. Okay, so again, we have a strangle position on Meta. This is a daily chart, and yesterday it failed to hold this breakout, which it shouldn't. This is the uptrend channel. It's a long-term uptrend channel. Each time it's broken out before, it usually retests or retraces back down to the lower band of support. So not good price action yesterday. They tried to bid it in the final 15 minutes. Too many sellers. It did not occur. So we're going to remain with our current position, no adjustments to be made today anyway at this point in time. Microsoft, same deal here, where we have what you call a ratio strangle. We sold more calls than puts because after topping out, Microsoft has gone into a downtrend. Now, this is a descending wedge formation, so we could break out of this easily. And if we do, we're going to want to balance out that strangle by selling more puts. We're not there yet. Let's wait for the breakout to occur. And these options, all of them, expire early in September. We're now in early August. So the time decay is going to begin to ramp up on these names. And once we hit that 50% threshold on profit, we're going to be get very, very mechanical, take these off the table, reestablish later dated option positions. So that way we keep ourselves out of trouble, just things in case things go a little bit messy in the market. Either we get a parabolic blow off top or the markets begin to break down. Can't rule out either one. And that's it, folks. Have an awesome trading day. Make it profitable. I'll talk to you soon. Be well.